go.
Well, welcome everyone to this webinar with Carbon Tracker and our discussion today with our friends at Repsol and Sarasin on the topic of oil and gas and the energy transition and Paris alignment. So I'm the chair of Carbon Tracker. We're a non-profit financial think tank, and we produce research and analysis primarily for a financial audience about the energy transition and what it might mean for shareholders and the banking system. So what we're going to do today is we're going to have a couple of presentations. My colleague Andrew Grant, who leads our oil and gas team, is going to present our latest research findings. And for those of you who subscribe to the Financial Times, you should be able to see a good article by my colleague Mike Coffin, who's also with us today, about Carbon Tracker's views on how do you go about meeting the Paris goals. So you can get that from the Financial Times, or you can see us tweeting about it. And then we're going to go to Luis from Repsol, and we're going to hear from the company's perspective, the industry's perspective. And then lastly, but no means least, from Natasha, Landell-Mills from Sarasin, who will be talking from the investor's perspective. So as with these webinars, there'll be a chance for you to submit questions and answers in the Q&A box rather. And we'll be picking those up, and I'll be moderating those, and hopefully we'll have a handy discussion through the rest of the next hour. So Andrew, I'm delighted to hand over to you.
Thank you very much, Mark. I will now share my screen. There you go. Has that worked? That worked okay? Excellent. Okay, so hello everyone. Thanks very much for the introduction, Mark. So as mentioned, I'm Andrew Grant. I head up our research on the oil, gas and mining supply side of fossil fuels. I'll try and be as brief as possible. I won't go through background in Carbon Tracker. I'm sure many people will be familiar with Carbon Tracker as a non-profit think tank, again looking at kind of issues around climate change and energy, but particularly with that financial lens. So I'll start off with the very high level picture, and that's really, I think, to restate the case that effectively stabilizing temperatures at any level, global warming at any level, whether that's 1 degree, 1.5 degrees, 2 degrees, 3 degrees or more, requires getting to net zero at some stage. This is a product of what's called the carbon budget, essentially the principle that it's the cumulative amount of CO2 in the atmosphere that ultimately drives warming. So if we continue to emit emissions on a positive basis, i.e. we are producing more than we suck down, then the amount of emissions in the atmosphere is continuing to rise, and hence the temperature will continue to rise. So that point about reaching net zero really becomes an inevitability to stabilize temperatures at any level. Now, the amount of time it gets you to net zero and the amount of emissions you emit in the meantime, then of course influences the ultimate temperature you end up experiencing. And the IPCC report back in a couple of years ago, tail end of 2018, illustrated that getting to 1.5 degrees will require getting to net zero around about 2050, even in scenarios where there's a very, very high level of negative emissions later on in the century. Compare that to the available supply of fossil fuels. So just using BP's numbers, proved reserves alone of oil and gas would last for about 50 years each at the current rates of production, coal around about 130. So you can clearly see the issue. There are finite limits put on us by the way our planet works, and we have more than enough fossil fuels available to take us past those. So when you're thinking about what that might mean then at a more granular level, think about the economics, you need to drill down a bit further, think about what the dynamics are over time for the different fossil fuels. And I show this briefly on this chart. So the dotted and dashed blue lines in the middle are the IEA's decarbonisation scenarios, a 1.7 to 1.8 degree scenario and a 1.6 degree scenario. The shaded grey area is the amount of supply associated with existing oil projects. So those that are either in production or those that are under development. In other words, have taken financial investment decision. As you can see, there's a little bit of a gap in between the supply, the grey shaded area, and the demand, those lines, meaning that there probably is a little bit of space for new fossil fuel production under those scenarios. But crucially, it's much, much less than the gap all the way up to their business as usual scenario, the new policy scenario, which is now known as the stated energy policy scenario, which is associated with about 2.7 degrees of warming. So the incremental gap for space for new projects is much, much smaller. The kind of suggestion that there might be space for new fossil fuel production, I think, again, it depends on the global warming outcome that you assume. If we are on the more conservative end of the Paris Agreement and go for 1.5 degrees and assume that CCS remains substandard, then we're looking at the dashed yellow line there, whereby there's already enough fossil fuels in existing oil, gas and coal projects to take us past that point. But generally speaking, for a well below 2 outcome, as long as it doesn't reach 1.5 or kind of leaving aside the aim for 1.5, tends to be a little bit of space for new oil and gas production. So where does that leave the industry, the oil and gas industry? Now, I think it won't be news to anyone if I mention the fact that stakeholder pressures are mounting and from a variety of different quarters. But what I think is unusual at the moment, or what has changed the game really, is the way that the environmental and financial interests both point in the same direction. So you might think about this firstly as kind of an alignment view, an alignment with Paris view, where companies want to be seen as part of the solution, maintain that social license to operate, be able to show their consumers and their other wider stakeholder group that they're pulling in the same direction as the rest of society. But then also crucially, there's the financial risk aspect. Companies want to be seen as financially resilient, producing as high returns as they possibly can, and avoiding investing in assets which might turn out to be stranded, in other words, destroy value as the world decarbonises. Now, at Carbon Tracker, we've argued that satisfying both of those will mean that for companies, we'll need to avoid sanctioning assets effectively that don't fit within a Paris-aligned carbon budget. I think we see it very difficult to see a company being able to call itself Paris-aligned if it's willing to sanction the projects that would take us past those Paris limits, and also which are, of course, the ones that run the risk of being stranded as the world decarbonises. Now, what that's going to mean is that in order to hit climate targets, emissions are going to have to fall on an absolute basis throughout the value chain. And this is going to mean that there's going to have to be lower levels of production rather than the longer term historical growth that we've seen. The industry doesn't seem to be quite at this stage yet. So even with the bigger players really talking about growth in production in the near term, although we are starting to see some of the names, BP, Equinor, for example, sort of commenting vaguely on the fact that they might be producing less fossil fuel in future decades. So just to come on to the sort of state of play at the moment, rather than looking at the issue through that lens of production, investment, the way the industry so far has approached it is, or most at a most high profile level, I think, is through the setting of emissions ambitions, called ambitions rather than targets, so they're non-binding. However, and this comes to the research that Mark just mentioned, which we released yesterday, so hot off the presses. In this research, we go through the recently announced carbon emissions ambitions and make the argument that well, clearly, all efforts to reduce pollution are a good thing. It's crucial, I think, that they reflect, of course, the underlying reality of our planet, the carbon budget, and hence show that real structural link to the way that planet works. And we highlighted 3 features, I think, that will help make that link. So firstly, given that we've got to reduce emissions throughout the value chain, emissions targets should cover scope 1, 2, and 3 if they want to be seen as kind of complying with Paris. Secondly, have an absolute basis of some sort, and I'll come back again to these briefly. Thirdly, they should include the vast majority of a company's production on an equity share basis. So I mentioned the rationale for the first point, including scope 1, 2, and 3, thereby means that include the emissions from use of fossil fuels, which are about 85% of the issue in oil and gas, rather than just the scope 1 and 2 emissions, which are only about 15% or so. I think the absolute basis point is a key one. Maybe it doesn't necessarily mean that companies need to set an absolute figure of tons. Maybe it does, maybe it doesn't. But they could also approach it perhaps another way, saying, we'll set an absolute limit on the amount of projects that we're going to sanction, for example. The reason this is important is that the way that, up until recently, the way that most targets have been set, and this is really talking about those green companies in the middle of the chart here, Shell, Equinor, and Total. The way they've set those targets is that they say we're going to reduce the emissions intensity of our production on a per joule basis. Of course, what this means is that those companies can actually achieve those targets by lowering the average intensity of their production. But if they get bigger at the same time, it doesn't necessarily mean that they lower their emissions overall. And of course, it's absolute emissions reductions that are going to be what ends up in a relatively good climate outcome. What separates the top three in our methodology is the fact that these three companies do have emissions that are targets that have an absolute character. And lastly, the point about equity share, I think, again, it's difficult to say a company's target really reflects the implications of their activities on the atmosphere if they're not including a significant amount of their production. For BP, for example, its targets don't cover its interest in Rosneft. Right at the bottom of the list, we have ExxonMobil, who not only don't cover Scope 3 emissions, not only do they not have an absolute basis to their target, but their CO2 target only covers their interest in Imperial Oil, the oil sands producer in Canada, which accounts for around about 4 or 5% of their production. So the companies clearly vary a great deal in the structure and that structural link to the atmosphere. They also, of course, vary a great deal in their scale. And here we think illustrates the importance of interim targets, because, of course, if a company has a net zero target for 2050, if they go hell for leather in the interim, that leads to a greater amount of emissions and hence greater warming. It also means that there's not so much of an incentive for management to act when perhaps a 2050 target isn't going to be necessarily that CEO's problem, or even probably their CEO's successor's problem. It gives more of that certainty that stakeholders and investors can really see that action's being taken. So we've included Repsol and BP as absolute based targets, given that they get to net zero, and net zero emissions is an absolute reduction. However, the reason we give the top spot to ENI is, as well as having a target that's set in absolute terms covering Scope 3 emissions, they also set targets in the interim on an absolute reduction, so stipulating reductions in both intensity and also in absolute terms. And indeed, ENI are one of the companies that are talking most about reducing their production overall, having said that they foresaw peak oil production of their own in about 2025. So I think, we've covered, of course, the environmental angle here, but we do think as well at Carbon Tracker, potentially as a read across here to the way that companies run their business from a financial standpoint. One might see that if a company is talking about the limitations on their fossil fuels, they really understand the limits that climate change puts on them, then they might be more inclined to sanction projects on a more conservative basis, whereas companies that assume that they can continue to grow unfettered, perhaps more likely to be those that invest in stranded assets going forward. Okay, so I'll wrap up very briefly. We've talked about the emissions targets, but of course, this is one part of a large picture, and really we do have, I think, a lot of strategic questions that remain open from the industry, and we look forward to hearing the panel's views on later on. So we've talked about the differing emissions targets. Another recently topical announcement has been the big write-off that BP faced when they lowered their long-term impairment prices. Repsol did similar last year. However, we still see many companies in the market assuming $70 or even $80, for example, in the case of Equinor, who are a company that have an intensity target to lower their intensity of emissions, but continue to assume high prices for fossil fuels going forward. There's also, for example, remuneration. Shell, for example, have an emissions target related to lowering emissions. At the same time, no less than 25% of their CEO's annual bonus is related to increasing the production of fossil fuels, illustrating the point that having emissions targets doesn't lead to absolute emissions reductions in total. Clearly a lot of other wider strategic questions that we could get into as well, but I'll just wrap up there so I don't go over time, and now pass over to Mark for the panel discussion. I think you're on mute there, Mark.
Just to clarify, Andrew, when you say absolute emissions reductions, do you mean, just to clarify that, what do you mean by that? Because some people would say companies not going ahead with particular projects. Is that what you mean?
So, well, to go back to my first slide, really, in order to get to a net zero outcome, which is an inevitable consequence of stabilizing temperature at any level, that's going to require much less use of fossil fuels. There are different ways that you can lower emissions on an absolute basis. So, for example, lowering your scope 1 and 2 emissions does lower your absolute emissions by a certain degree. However, in order to deliver the reductions that would deliver a net zero outcome or any sort of decent climate outcome, is going to require overall lower production, lower emissions from companies, and inevitably lower sanction activity.
Yeah, okay, just to be clear, that's correct. And that particular report that we've just seen is downloadable from Carbon Tracker's website on the oil and gas page. So thanks, Andrew. I'm now going to hand over to Luis from Repsol, who's going to give his responses and reactions and say a few things about what his company's been doing.
Oh, okay. Thank you very much, Mark, and well, a pleasure being here and share some views to start with on this very interesting topic of ambitions in the energy and oil and gas sectors with regards to climate. Yeah, I would like to emphasize and start by saying what fundamental changes we have undergone during the recent years. Mark was commenting before about the level of alignment as a first stage of the oil and gas companies on recognizing the nature of the climate change problem and the willingness to be part of the solution. If we think back just maybe 5 years ago, this sort of alignment didn't exist. So let's say that basically the world, and as a consequence the energy sector, is now very much aware of the problem, of the dimension of the problem, of the challenge, and willing to be part of the solutions. Now, when moving into action, probably what differs between companies is the perceived pace of the energy transition. Logically speaking, if one company believes that energy transition will take many, many years to happen, then their approach will be more conservative. So I would say that in the oil and gas sector, a number of companies, some of them are being shown in the comparison of Andrew, have taken some sort of lead and say, okay, the pace of change is gonna be fast enough such that we put metrics and we put targets, and we translate that target into action, into strategy and investment allocation. So again, just to highlight how fast things are changing, this group of companies have recognized that when computing emissions, we should include not just the so-called scope 1 and 2 emissions, which are the traditional emissions we were taking care of in the past, which is what we are emitting while we are extracting hydrocarbons, transforming and selling products. So these are just direct emissions. When you incorporate, and a limited number of companies have done that, scope 3, which is the CO2 emissions derived when our products are used, things are really different. It's well known that scope 3 emissions may be 5 to 6 times higher than scope 1 and 2. So the dimension of the challenge to decarbonize is much, much bigger. So in order to see which ones are taking the lead, definitely the first question, as Andrew was emphasizing, is whether or not they are incorporating scope 3 to their metrics. Second is, well, once we are there, the next point is how to measure the progress. And now it comes to a little bit of complexity, and well, we recognize that now, maybe 1 year ago, the market was really confused about energy intensity, whether or not they were relative or absolute, whether or not they were included in scope 1, 2, 3. I believe that thanks to the work of Carbon Tracker, TPI, and the transparent information that some companies are providing to the market, the clarity is coming into this little mess of metrics and targets. And really, I value very much, we are getting different comparisons. Not all of them are still showing, let's say, in the ranking the same positions, but definitely the market and the investors are right now starting to understand the nature of the problem, starting to understand the response of the oil and gas companies to the challenge, and well, they can take much better informed decisions about how to invest and how to allocate their investments. So definitely, again, I wouldn't like to look very, let's say, just positive, everything is done. There is a lot of work still to be done. And my point here is that first condition is that companies provide transparent, complete, open information about how we are measuring metrics, how we are putting targets, what do we mean with the net zero, etc. From that dialogue, we can move then to standardization. That is something that is quite desirable. I don't know whether or not all the companies will be, let's say, absolutely in agreement which is going to be the best metric. But what definitely all the companies can do is provide sufficient information for the investors and the analysts to take their own calculations, to manage the information in the way they consider that they should make comparisons and ranking the position and the ambition, the climate ambitions of the company. So definitely we are doing a lot of work now with you, Carbon Tracker, with TPI, with others, in order to provide as much information as is required in order to have a fair view about our efforts. Now, I fully agree again that normally we are putting the end state ambitions, net zero 2050 or whatever. Interim targets are very, very important because 2050 is very far in time. So we need to approach things and explain what we are going to do in 2025, in 2030, in 2040. So definitely, I fully support, we as Repsol fully support the concept of putting interim targets. And then when you are putting the ambition, you can draw scenarios and try to explain how you see your company in 2050. But these are scenarios because you do not have all the information about technology evolution, etc., etc. But when you are speaking about 2025 and even 2030, then you can bridge the targets with the strategy, the capital allocation, and the investment decisions. And well, later on, we can speak a little bit about if you want to us to translate our 10% or 20% intensity reduction in 2025 and 2030, what that means in terms of capital allocation, in terms of what you're going to do in order to, how you are going to get these levels of decarbonization. So basically, this is my starting point. Definitely later, if you wish, we can speak a little bit more about in each of our business segments, exploration and production, refining, new businesses like renewable generation, what we intend to do to decarbonize the legacy assets and to change our energy mix through basically entering into the renewable power generation. So let's leave, let's say, for further discussions, these topics, if you wish, and I leave the floor open to others.
Thank you very much, Luis. On your kind of concluding points about what you describe as leaving behind a system and moving towards the renewable energy side, it's quite interesting to hear you describe it in that way. So thanks for that. And I'm now going to hand over to Natasha for your comments, and you may want to also introduce yourself and your role to our listeners. Thank you.
Yeah, sure. Thank you, Mark. And just as a kind of sort of alert, I've got open windows here because it's very hot and I'm afraid it's quite busy outside. So if you can't hear me, please just wave or something like that. So I'm Natasha Landell-Mills and I head stewardship at Sarasin & Partners. We are a medium-sized global equity asset manager. We manage roughly $20 billion US in AUM, and we have a particular focus on the charity sector. So we're the third largest charity manager in the UK. So That gives you a little bit of a sense of where we're coming from and our interests in climate change issues, very much driven from our client base, as well as obviously from ourselves. So first of all, thank you both, Andrew and Louise, for your remarks. I guess where I would like to start, and I'm going to try not to be too long on this, would be to say I think there's a really big trust deficit. And the reason that's important is I feel like that underpins all of these discussions. You know, I think in a perfect world, you wouldn't get shareholders trying to get into these sorts of detailed discussions about CapEx, strategy, this and that, because you would trust the board to get on with it. And at a pretty high level, you'd, you know, understand the strategy and feel that everybody was aligned. We don't have that here. And I think one of the reasons we don't have that here is that the numbers, the financial statements that are very much underpinning business decisions are not aligned with the Paris Agreement. And until those numbers are aligned with the Paris Agreement, there's a danger that behaviors will not be aligned with the Paris Agreement. And then you do require all these other mechanisms to effectively get management and companies to go in the right directions, you know, commitments, ambitions, this and that. What are your targets? What are your metrics? Let's work, you know, do this on a rolling basis. And I worry that that's not going to deliver for us at the end of the day, with obviously horrendous consequences for the world. So our big focus as a result has been, for the past 4 years, I was just totting it up the other day, has been on the accounting side and trying to understand what are the key assumptions going into oil and gas majors' accounts, and whether those assumptions can be considered to be aligned with the Paris Agreement. And when we started and we produced a report, our first kind of public report in 2018, you know, climate risk, Paris, there was total radio silence on those issues in the financial statements. You were seeing it in the narrative, and of course at that time you had the TCFD, and there's quite a lot of discussion, to the point that today it is absolutely, you know, the beating heart of strategies, you would think, from the narrative discussion. But you still have this disconnect with the financial statements. We've had a big improvement in the most recent annual report and accounts that were just published in 2019, and I'll just talk you through some engagement work we've been doing behind that. But that is a really, really critical issue. And I really would love to get across this core point, because we cannot make the progress we need to make on TCFD until we get Paris-aligned accounts. So that needs to be a really, really important target for all of us. Including businesses, by the way, because I think it would take a lot of the heat out of this, because they would then be aligned, right? And we wouldn't need these sort of discussions. So just if I just take you very briefly through the engagements we have been doing. So as I mentioned, in 2018, we did this overview of the European oil and gas majors and looked at the critical accounting assumptions. We had an engagement going on with Shell anyway on that, and they had, for the first time in their 2018 report and accounts, published the long-term oil and gas price assumptions. We decided through this analysis that that was one of the most important assumptions. And we didn't decide that just by ourselves. We decided that because the auditors in their reports to shareholders were telling us the long-term oil and gas price assumptions were amongst the most critical assumptions going into the accounts. And therefore they were often part of what's called the key audit matters. And therefore, you know, we picked that up and we looked at those assumptions, and they were largely making these assumptions that were quite high, between $70 and $80, whereas work by Carbon Tracker and others, and Rice and others, was suggesting that in a Paris-aligned world, you'd be looking at something closer to, you know, $30 to $40. And certainly in the front end of the very same company's annual report and accounts, they were talking about how their strategies needed to be, you know, one famous statement, I think, from Ben Van Berden is that we have to be fit for 40. You know, so we need to be prepared for a $40 world, taking into account decarbonisation. But, you know, BP in their accounts was assuming $75. So let's fast forward to today. As Mark mentioned at the beginning, BP has just made this announcement that they're reducing from now $70 to $55. They actually, in the reporting council, just came out, a matter of weeks ago, they reduced from $75 to $70. So there's a question as to why they waited, but we'll come on to that. But we, and I say we, there was a collective of roughly between 20 and 30 investors wrote to the audit committees for BP, Shell, and Total, and that letter was sent in November. We've just published them this week on Monday, so you're free to have a look at our website to see those letters. But those letters were sent setting out very, very explicitly what investors' expectations were for Paris-aligned accounts. And they referred, importantly, to regulatory developments and guidance from the International Accounting Standards Board, saying that we need no new rules. There is no need for new rules. Under existing rules, companies should be taking account of material climate risks. That's absolutely clear. There's no need, there's no special treatment for climate risks. If they're material, they need to be taken into account. So that was very, very helpful. And I think that was actually one of the key reasons that all three of those companies in the 2019 annual report and accounts, first of all, made quite significant increased mention of climate risks. It became for BP a key audit matter, for example, as well as appearing in other key audit matters. It was throughout all the key audit matters for Shell. For Total, the auditor was silent, oddly, but in the notes of the accounts, they talked about decarbonisation, and all of them lowered their long-term commodity price assumptions. Shell went further to $60. And Shell had the previous year come down from 80 to 70. So that's quite a big drop. So on the back of that, it was quite interesting. We noted that in the auditor's report on that, they highlighted, this is Deloitte, very explicitly that the $70 that BP was then assuming was well above what would be consistent with Paris. And we had asked Shell's auditor to do that. In other words, we asked all the audit firms as part of a separate and parallel engagement to make sure they highlighted to us where assumptions were not aligned with Paris. And they did. And that was incredibly helpful. So we've now had this announcement from BP. They have obviously seen the light, whether that is because of COVID, I don't know. But the critical thing is it's because they see accelerating decarbonisation, and they recognise that those prices they've been using in the past are no longer relevant. And the materiality of that is absolutely crystal clear. Between a 13.5 and 17 billion impairment, that's, between 15 and just under 20% of their net assets. That's wiping out quite a lot of shareholder equity. That's a one-off, of course. But the question is, where do you stop with this, with those prices? And I think probably one of the most important takeaways from all this is, first of all, the point of principle has been accepted. That Paris alignment is relevant to your accounting practices. And that's really key, because that goes far wider than oil and gas. We've written also to CRH, a cement company, and other letters are in the pipeline, and I would say banks too. Bank loan loss provisioning currently does not take account of decarbonisation. And as soon as you do, you will see an increase in loan loss provisioning. That's my view. And that means lower profitability for banks and also a hit to capital. And that, I believe, is why the central bank, the Bank of England, is so concerned about this, because from a prudential perspective, it will hit capital, and you need strong capital buffers at banks for macroeconomic stability. I'll stop there. I got lots more that I'd love to say, but I want to give a time for Q&A.
Natasha, I'm tempted to say, don't stop there. Keep going. I find your comments fascinating. They concur with a lot of our own thinking and findings. So thanks for that. Both Lewis's contribution and your reflections are central to how we go about resolving this the smooth energy transition that we're all looking for, and avoiding a calamitous, disorderly transition. And the accounting angle and what companies say is crucial. And we know companies are saying different things, which is my way of saying how we can set up some questions and answers. We've got some questions coming through in the Q&A box, which we'll look at. And I have one already. And And my first is, following write-downs at Repsol and BP, what's next in terms of the practical implementation of the energy transition into the oil and gas producer business models? So I know we've talked a little bit about that, but let's tackle that question first. Following write-downs at Repsol and BP, and you can infer from that what's the significance for companies who didn't write down, and what does that mean for the auditors who didn't do the write-downs in the other companies? What's next in terms of the practical implementation of the energy transitions in oil and gas producer business models? Now, you're going to have to wave at me as to who wants to answer that first. So whoever puts their hand up first gets first dibs. Oh, come on, where's the enthusiasm? Lewis, thank you very much. Over to you.
Thank you, Mark. Well, what's next? Definitely, I believe that Natasha put very fundamental elements of the discussions on top of the table. Because at the end of the day, if we want to be Paris aligned, we need to refer to energy scenarios. And Andrew putting some examples on how different the scenarios can be depending on where you put your, let's say, limit on 1.7, 1.6, or 1.5 degrees C. That will make a huge difference for the demand of oil and gas in the future, and also even at the same level of temperature limitation, depending on your assumptions on the technology evolution. Then you move more towards a pure renewable world, or you can have a more coexistence of different ways of energy, primary energy, with decarbonisation technology like carbon capture, etc. So my first point is, and this is not at all being Paris disaligned, is how you look at the world in the future, 2030, 2040, 2050, and which are going to be the winning scenarios depending on the evolution of technologies, based on being Paris aligned and being on a fundamental wish and decision to control the climate and to control the elevation of temperature. So my point here is that reaching a point in which we can agree on which is going to be the price, because we were speaking about financial statements, about, let's say, investment allocations, whether or not investments are aligned with Paris. We need to recognize that there are different levels of scenarios that will put the price of oil definitely lower than in a world of no problem of climate, but whether or not it's going to be $40, $50, or $60 per barrel, the view will make a difference on the financial decisions and the impairment decisions of the companies. But it's true that certain companies have gone further and we have been a little bit faster on putting in place these impairments. In our case, we have gone to a world of the type of prices of oils shown by the International Energy Agency in their Sustainable Development Scenario, that for the time being is 62 degrees C in 2035. Okay,
so,
whether...
Lewis, whilst we've got you on the floor, Repsol obviously was the first to make an announcement about write-downs, which was, well written about and received. What was did you have reactions from other oil and gas companies looking at what Repsol was doing and asking you questions about that? And there wasn't, seemingly to me, a dramatic response in terms of the market. It seemed to be well received. Do you, as you're speaking now, can you give your own reflections as to how the market reacted positively or negatively, and what were others saying to you when you did it? Yeah. And don't be long, because we're going to switch next to Mike and Natasha.
Very quick. In the very short term, the market was a little bit flat. If you look at the value of the market, was flat, but the qualitative market reaction was positive. Then our peers, we are part of OGCI. At that time, we were meeting with other companies, and generally speaking, all companies, in some way congratulated us to say, okay, we see that as a big movement. They were speaking about our net zero ambition. they were not speaking specifically about the impairment decision. So there was not much comments on the impairment part of the decision, but definitely on the net zero ambition was really genuinely well received. And I believe that a reflection of that is that later on and very soon, other companies, probably was not as a consequence of our movement or as a direct consequence of our movement, but definitely they were undergoing their own reflection and very fast they reacted.
Yeah, I bet they were. I bet they were. Now, who's next? Andrew, did you want to respond to that?
Yeah.
I'll pass on to Natasha for this one.
Yes, Natasha. I mean, one that's always interested me, Natasha, is we've got two companies doing it, BP and Repsol. The auditors and the accountants are going to be the same, I'm pretty certain, for them as they are for the other oil majors, but they're applying different principles. What's that all about?
Yeah, great question. What is that all about? I think that's exactly the question we need to be asking the audit firms. And indeed, it is a question we're asking the audit firms. I think, you know, to give them their due, we, as I said, we'd also had a parallel engagement with the Big Four in the UK. They do operate, generally speaking, a franchise model. So, you know, but they come together. Obviously, they have a sort of general central sort of repository of guidance and things like that. So there is obviously communication. But we'd written in January 2019 to all four, setting out our expectations, and we had an extremely, broadly speaking, there were contrary examples, but broadly speaking, an extremely positive response. Deloitte and KPMG put out papers, you know, setting out exactly how financial statements need to be updated to reflect climate risks. And then when we wrote to the audit committee, we copied to the lead audit partners. But you're absolutely right to point out, Mark, that this is clearly not universal. You also have in the US major laggards, I would say, on the financial statement transparency side. There isn't even a disclosure of those critical accounting assumptions, even though FASB rules, that's Federal Accounting Standards Board, as well as SEC rules, demand, I would say, on the face of it, that material information is made clear to shareholders. And so on a pure market efficiency basis, those companies in the US should be disclosing their critical accounting assumptions, because without that, if you like, you're comparing apples and oranges. So if BP is $55 and Exxon, let's just say 80, because I have no idea what they're using, you simply can't compare the financial statements. And as a result, how can you deploy capital on an international basis?
Well, that's a good point. And certainly, you know, one for the regulators, the TCFD and its recommendations around scenario analysis, you would have thought the oil and gas companies will be stress testing against lower oil prices. And I'm hoping, well, why do you think, Natasha, that regulators and others are part of TCFD in their recommendations on scenario analysis aren't recommending these lower oil price stress tests across the board? Or do you think they don't want to be so prescriptive?
I would love to know. Again, I mean, we made a couple of submissions into TCFD when they were getting off the ground saying, look, you know, we think this is great, but the scope is too narrow. You need to include the financial statements. You will know, of course, that the audit firms were contributing quite a lot to that process. And you know, and certainly it's odd to me, given that they were contributing again, that financial statements were left out. But of course, this is already a legal duty for them, as I was referring to before. This is not voluntary. You know, this is about regulators enforcing existing rules.
And clearly they're not. So Mike, Andrew, you both used to work in the oil and gas industry in one shape or another. So these are going to be issues that you're both familiar with and you've talked about in your latest reports. Did you want to comment on that question?
Yeah, I'll comment briefly and then pass over to Mike in case he's got any other points. But I think worth bearing in mind as well, you know, I think, you know, the point on accounting is clearly well taken. I think it's sort of instructive of the direction of travel and the way that we are shifting, I think, from an appreciation of the issue to now, like, how do you actually make the nuts and bolts of your business reflect the reality of the climate we have around us? So I clearly, price assumptions feed into a lot of things. They feed into, well, they underpin so many parts of the balance sheet and the income statement. but they of course also feed through to the way that companies view their project sanction. So Carbon Tracker's own work shows that over the last couple of years, all the major oil companies look to sanction projects that don't fit within a low carbon world, don't make economic sense within a low carbon world. Perhaps with this shift towards lower oil prices, we might start to see that trend changing in future.
Right, now I've got other questions coming into the Q&A box. I'm going to take one of them, which hopefully can be answered relatively quickly. What oil price, in your view, is consistent with the Paris Agreement in 2030 and 2040, which are these sort of stagings? And I think as a corollary of that, do you think, based on what you've said, Natasha, that regulators should be given specific guidance on where the stress test should be on the price? If anyone wanted to answer. So what oil price is consistent with the Paris Agreement in 2030 and 2040? And I'm not going to ask you to predict the oil price. I'm just going to ask you what you think is consistent.
Is that for me?
Well,
yeah,
so let's take Luis, because he's got his hand up, and then we can come to you, Natasha.
Very quickly, I mean, we need to refer the price of oil to a certain energy scenario. So if we take the sustainable development scenario of the agency, then it should be around $60 by 2030, $62 by 2035. So that's my answer. I'm very quick also. We need to also and it's very well taken, the time frame. The type of risks of capital allocation, stranded assets, it's not the same for a company that has proven reserves of 8 years than for other company that has proven reserves of 20 years. So it's very easy to understand that. So there is also a consideration when comparing risk, climate risk, price of oil definitely is one big element, but others in order to judge whether or not further investment in hydrocarbons are Paris aligned or not, probably a good starting point would be to ask about the proven reserves life of the companies.
Mm-hmm. Natasha or Andrew? Do you want to pick up on?
Point it back to Andrew, because you guys obviously have done some work on this using Rystad data. So I think that's definitely been something I've referred to. Aurora has done work. And as Luis mentioned, IEA has done work, though many would argue that's not, that's Paris consistent perhaps, but not consistent with 1.5 degrees.
Yeah, and that's a good point, Natasha. And Luis, you mentioned the IEA, but of course they don't have a 1.5 degrees aligned pathway in their own forecasts, which is something that a lot of us find quite curious. But anyway, that's an aside. Natasha. Sorry,
well, it's an important aside, actually. That's another, effort, if you like, is to get them to produce precisely that pathway. Because now that we are seeing oil and gas companies say, yes, okay, we're going to make Paris-aligned assumption, as Repsol has, then they're using the IEA Sustainable Development Scenario. But is that now anchoring them at the wrong level? I mean, it's certainly a step in the right direction, but getting the IEA to produce a 1.5 degree consistent price pathway, I think would be very important. And I'd love to see the oil and gas companies publicly ask them for that. Certainly investors are publicly asking them for that. And if we could have a alliance on that, it would be fabulous, because I think then we would have a very credible third party reference point for ensuring that these accounting assumptions are consistent. I mean, the only other thing I would say, and we were touching on this prior to the panel, is that prices are dynamic, of course. Yeah. And, kind of what we're talking about is a direction of travel here. They're based on existing technologies and existing situations, for example, the OPEC cartel, if you want to call it that. All of that can change over time, and you could get quite big shifts in both the demand side and the supply side, which would lead to very different price assumptions. So you will always need to be updating that. But that is another reason, I think, for someone like the IEA to make sure that they're producing that on a regular basis.
Yeah, okay. Now we've got other questions coming in. One from our good friend Yanku at Elgin, that if you take what we're saying about stress testing on these lower prices and lower demand for oil, do you think companies should be taking some kind of impairment charge or write down of fixed assets in line with the Paris Agreement? Because of course, a lot of the companies are saying, oh, demand for oil is going up in the next 20 years, therefore all our assets have a useful life. Whereas to be consistent with the Paris goals, we would anticipate a lot of asset write-downs. What's been your experience of that, Natasha, and then I'm going to ask Luis about whether you've had any thoughts about that in the context of Repsol's business. But Natasha, have you raised this with companies?
I think that's what we've just seen with BP, unless I'm misunderstanding the
Yeah,
question.
no, so they was a write down of their reserves, whereas
No, they've
you've
written.
got.
Yeah, sorry. I think you'll find they've written down PPE as well. They roughly,
Okay.
I think roughly half of their write down was exploration and production assets, which are often under intangibles. And then the other half, I believe, came from tangible assets, such as PPE. I think Repsol actually, and Luis will be able to confirm this, also wrote down some deferred tax assets. So if you go through the balance sheet, you know, you've got PPE, your property, plants, equipment, you know, some more tangible concrete assets. Then you've got those assets associated with reserves, which are also quite concrete intangibles. You've got the exploration, development assets. But then you've got things like goodwill, deferred tax assets, which can be in, you know, multiples of billions. It can be a really big part of their balance sheet. And they also...
Very good. Good, yeah. I mean, Carbon Tracker, we've put our own estimates at around 30 trillion plus of fixed assets in the global fossil fuel economy, pipelines and platforms and so on, that will have to be written down in line with the Paris Agreement. Luis, how are you handling this at Repsol? And Natasha commented on BP's write down, including other aspects beyond reserves. And can you comment about how Repsol approached it?
Well, when we did our write-downs back in December, definitely a significant part of it came from, let's say, changing our price scenario to the sustainable development scenario of the agency. But also there were some percentage that was due to relatively low gas prices in the short term. But basically, the big component was the sustainable development scenario, the different price of oil. But I heard what Natasha said about oil price and volatility, and she's very right. That's why I believe that to fully assess the let's say the climate risk for any specific oil and gas company, on one side is the matter of the oil price, the gas price, and how this affects asset valuation. But the time life of the assets and the proven reserves you have in your books, it's also a very significant component on how intensive your write-downs can be if you look at the longer-term price of oil. So, and this is something very material, and you will see very different levels of write-downs depending on whether you have a relatively short life of reserves or you have very long life of reserves.
Great. Well, thank you for that, Luis. I've got other questions coming in, and one of them, Andrew and Natasha, in your view, do you think any of the oil and gas companies that are listed have business plans and investment plans that are aligned with the goals of the Paris Agreement? Yes or no would be a good answer.
No, I don't think so.
Andrew?
Yes, so this is a question we explored in a report called Breaking the Habit, September last year, where again we found that based on our view, it looked like all of the companies, all the major companies, are continuing to sanction assets that don't make economic sense in a Paris-aligned world. So I think, you know, on the basis of that.
So if that's true, if what you said is true, what further? I've got another question. What further steps might investors take if they don't see enough detail or progress? What would you think next would happen?
I'll pass over to Natasha for the
shake up of the board. You've talked about, Natasha, you talked about the wrong incentives, and that's clearly one place to start. Yeah. You've still got shareholders signing off incentives that reward volume over return on capital. I mean, are we winning that particular battle?
You've got a number of questions there. I don't think we're necessarily winning it. I think we're stepping, taking kind of quite baby steps right now. But what can we do? I think there are very, very clear things that investors can and should be doing. I think we need to move beyond shareholder resolutions, which I think have been very effective. But I think now we need to start changing boards. To your point, Mark, I think we need board shakeups. If the board is not delivering a Paris-aligned strategy, I think we need a new board. I think if the accounts are not Paris-aligned and therefore ensuring that that Paris-aligned strategy is being delivered, then I think you definitely need a new audit committee, but I think you also need a new auditor. We have all of these votes, you know, depending on the jurisdiction, it will be binding or non-binding. In the US, it's all famously non-binding, but it still matters. You don't always get a vote on the auditor, but in most jurisdictions you will. In the UK, you certainly do. Don't know about Spain. In France, you will every so often, etc. So I think we've got to start using these votes. They are powerful. The other thing I think needs to potentially happen if shareholders don't get their act together, which is quite possible, is governments simply require directors have in their articles of association a commitment to align with Paris. I mean, you've got the UK government and France that now have statutory targets to get to net zero by 2050. How do you make that happen? You make it happen by making every single company put into their articles of association that they will be net zero by 2050. And then again, you get away from micromanaging because then directors have a legal duty. And
right, now, thanks, Natasha. Now, I'm conscious that we've actually only got 3 minutes left, and I'm going to take what you've just said as your concluding statement. You made some very powerful points about what boards should do and what shareholders could do. Can we turn to Luis as next as the guest, who about your concluding comments? And we're down to the last 3 minutes. So, and Mike's not said a thing, so we might be tempted to draw you out for a few seconds. But anyway, Luis, do you want to give us a minute and your concluding observations?
Oh yeah, what my concluding remarks would be let's continue, let's say engagement and dialogue. We need to explain and definitely we are following the requirements of TCFD to show which are the climate risks and opportunities. So we need to continue this type of dialogue in order to make investors to take their own judgment on whether or not our investments are Paris aligned. My point here is probably it's better to look at, let's say, which are the decarbonisation targets, look at that, whether or not this covers the expectations of Paris. Then we can explain in our interim targets, which are going to be the investment decisions that will accompany every of the decarbonisation targets, and see that at portfolio level. My single remark, one could say one single investment in oil and gas is not Paris aligned. If everyone do that in the world, maybe in a limited number of years with the natural decline of oil and gas, the price of oil would be $100 again. So it's a matter of portfolio. We need oil, we need with time less oil, and it's a matter of portfolio changing rather than one single investment being qualified as Paris aligned. Thank you very much.
Thank you, Luis. Andrew? I think you've got the floor left, actually, Andrew. You've got 1 minute.
Yeah, okay. So I'll just wrap up briefly by noting that I think that, there are a lot of different things coming together here. Clearly, we started off on emissions, when emissions targets, went through sanction practice, went through impairment targets. Very large topic to cover in an hour. But I think that speaks to the fact that this is something that really goes right to the heart of the business model of oil and gas producers. I continue to think there's a long way to go.
Thank you for that. And I want to thank everybody for their participation today, particularly those that submitted questions, for Luis from Repsol for being generous with your time, and Natasha, also your reflections on this important work you're doing. And everybody, today was recorded, I believe, and should be available. And hopefully the questions and answers will be answered in future reports by carbontracker.org. Follow us on Twitter @carbonbubble and continue with us in this discussion. Thank you very much.